Gundlach got a lot of headlines from the Sohn conference yesterday. He said a few notable things regarding ETFs. So who better to talk about that than our Eric Balchunas, senior ETF analyst at Bloomberg Intelligence. So his big idea, his big trade was short the SPY, long EEM, which is the emerging markets ETF. And I want to bring up a chart, first of all, Eric, to look at how this trade would have performed over the past year. So we have a chart in the Bloomberg terminal that shows that basically the long EEM part has worked well. It's the short SPY that hasn't worked as well. So it's basically been kind of a break-even trade over the past several months. What do you make of it?
Yeah, sure. So a couple things. First of all, if you've ever seen Gundlach present, he's one of the best. Part of the reason is because he's very bold. He makes a lot of calls. He's very sure. And he's made this call a couple times. He loves India, for example, loves emerging markets because they're cheap, right? The PE is about 15, the S&P it's about 20. The S&P is up 95% over the past 5 years. EM is up 10%. So it's a pretty enticing trade. I think being bearish stocks as a bond manager isn't that unusual either. In terms of how to play it with an ETF, it's interesting he used EEM and SPY. As an analyst, we spend our days, sorting through all the products, and there are way cheaper ways to do that. I think if you're a retail investor and looking to put on a trade like this, you don't have access to shorting an ETF, so you could go long SH, which is the inverse S&P. And then on the EM side, EM typically, unless you're a big institution putting a ton of money to work and have like a window of 2 weeks or less, might as well use one of the cheaper ones. EM is 69 basis points. IMG and VWO are both 14 basis points, and they're the ones taking in the lion's share of the 20 billion that you've seen coming into the market. And so it's not lost on investors that EM is doing good this year. It's taken in $20 billion.
Right.
The big difference, though?
We have a chart of that as well, I should mention, if we want to pull that up on the Bloomberg as well. It shows some of the inflows into EEM specifically. It's the blue line there. So we've seen definitely some big inflows.
And this is a shocker. This was supposed to be the non-Trump trade. It was supposed to be America first. So EM is looking good. It's got a good valuation of 15. But crucial point here, if you're looking to invest in EM, keep in mind IMG, which is the iShares, that's going to give you South Korea and no China A shares. Whereas VWO is going to not have South Korea, and it's going to give you China A shares. So those are two big allocation differences that a lot of people miss.
And of course, that's always kind of the caution with ETFs, right? Look at what's inside of it. That's not all the Gundlach said. And I want to read the quote here from his presentation. He talked about passive investing as it relates to ETFs. He said passive investing doesn't even exist. It's just rules-based investing. The S&P 500 isn't even rules-based. It is run by a committee. People are blindly handing their money over to an investment committee they know nothing about.
I think he's right. He's onto something here, and I wrote a column a couple months ago about how most passive is really active. The S&P is picked by an index. Academics will tell you that true passive is taking all of the stocks and market cap weighting them. Well, nothing really does that. Even the S&P is only large caps. Then it's picked by a committee, and if you look at the S&P and you break down the holdings, look, it's 25% tech. FANG stocks went from 2% to 7%. You got a lot of momentum baked into the S&P. So I think he's right to question it all. I think where passive really is penetrating the market is because it's cheap. Low cost is really the mother of all trends because even active managers, there are active funds taking in money, but they tend to be cheap ones from like DFA and Vanguard. So I think low cost is maybe what was missed there. And also the ETF wrapper is more tax efficient than the mutual fund wrapper without capital gains. Those are important parts of that conversation.
Okay.